A little over a year ago, I wrote a post on LinkedIn that received over 10,000 views. Based on the popularity of that post, I thought it might be worth giving an update, especially because the outcome is quite ironic. Before I get to the update, here is my original post. Recently, I came across a deal that we previously offered on but was awarded to another buyer. I did a high-level comparison where we differed in our underwriting, and here are the results. First, rents. They projected over $300 a unit in rental gains, whereas we projected only $140. The differential is due to the comp set. If you do not recognize the true comps to your property, in other words, what prospective tenants consider when looking for a place to rent, you can put yourself in a precarious position, one in which you can never get ahead. The reason this is very dangerous is because not only does it impact your cash flow, but it also impacts your ability to exit, as pricing is typically based off of the NOI approach. Number two, natural appreciation. Currently, there is some healthy appreciation in the market. However, that's going to continue at today's rate? I don't think so. The sponsorship believed that it would for 3 years. In comparison, we underwrote appreciation for year one and then scaled back for the next subsequent years. Number three, inflation. I've seen this on so many offerings, and I'm not sure why it's not being called out. If inflation impacts your income, it should also impact your expenses. Too many times I have seen underwriting account for inflation in income, but not in expenses. This was the case in this sponsorship's underwriting too. Number four, economic occupancy. Economic occupancy almost always is less than physical occupancy. The sponsorship's model had economic stabilized occupancy greater than today's current, historic, and future projected physical occupancy. Typically, the only way to achieve such high occupancy is when the rents are below market. I already mentioned how aggressive their rental gains are, so I'm not sure how occupancy can keep up with the rents or when the rents are so high. So what does this all mean? When you're vetting an investment opportunity, I'm a huge proponent for vetting the team first, the market second, and the deal third. However, when the fundamentals of underwriting do not make sense, that is more a reflection of the team than the deal itself. To translate everything above in an offer price, we offered only 83% of what this sponsorship paid for the property. This is not the only deal our offer has been off by approximately 20%. More and more deals are trading for insane prices. Some may argue we should sit on the sidelines or maybe change our underwriting, but we're not doing either. We're sticking to our fundamentals. While we may not get a lot of deals, the deals we do get will be worth the wait. Okay, so now the update, or the $22 million question, which is, how is the property doing? Funny you should ask. A couple of weeks ago, I received a call from one of the partners who bought the property. They told me that they had heard of me from multiple people who said that if anyone can get a property before me, it's me, and that they desperately needed my help. While I appreciate the compliment, the situation is quite difficult because they've paid way too much, basing their price and business plan on an unobtainable reality. Just as I had noted a year ago, the rental projections were too high. Side note, there have been tremendous rental growth over the past year, so the fact that they still couldn't hit the targets is scary. The other things I pointed out also came to fruition. Natural appreciation is not occurring like it was a year ago. Inflation did impact their expenses too, obviously, and the economic occupancy actual and future projections are aligned with the historics, thus not even close to their projections. So what did I do? As much as I would love to help this group out, as I've done for other owners and operators, I think this investment opportunity is past the point of saving. Personally, I think the partners should minimize the loss and be transparent with their investors. Specifically, I think they should arrange a discounted sale even if that means they lose money. As this is a tough pill to swallow, especially on the ego side, multiple investors are opting not to do this. Instead, they are holding the property until the very last minute when the lender takes the asset. This is obviously the worst outcome that could happen for all parties involved. There's a very famous saying that has become a key guiding principle in real estate fundamentals. Money is made when you buy. Over the past few years, this basic concept has been forgotten. Numerous investors, even very famous ones, were quoted as saying real estate values always go up. Today, we are witnessing the fallout from investors who relied more on factors they could not control, for example, interest rates, market demand, inflation, and appreciation, than the ones they could. Basic operations. In fact, I would even argue that it was their lack of operational knowledge that got them in this predicament in the first place. As always, if you like this video and want to see more, please like, subscribe, and share.